ask you something. Have you ever pulled up a home on Zillow, looked at all the pictures, and imagined yourself living there? And then you closed that app because you thought, there's just no way, not with my credit. Well, if that's you, I need you to keep watching because what I'm about to tell you might completely change the way that you see your options. My name's Kat Neal. I'm a realtor here in Central Arkansas, and I work with buyers and sellers from across the area, from Little Rock to Cabot, Maumelle to Bryant, and everywhere in between. I also speak Spanish and Portuguese, so if that's your preferred language, you're in the right place. In my last video, we walked through the entire first-time home buyer process from start to finish. And one of the things that I touched base on was the loan options, specifically programs designed for buyers who don't have perfect credit. And I heard from so many people after that video who said, but what about my credit? Is it really bad enough to disqualify me? So that's what this video is going to be about. We're going to talk about credit, what it actually is, how it affects your ability to buy a home, what the real minimum requirements look like, and most importantly, what you can do right now to get yourself in a better position. Even if you've been told no before, even if you had some hard financial moments, even if you're starting from scratch, this video, it's for you. So let's get right into it. Let's start from the beginning because a lot of people don't fully understand what a credit score actually is, and that's okay. Nobody teaches this stuff in school. Your credit score, it is a 3-digit number, typically somewhere between 300 and 850, and it represents how reliable you've been paying back the money that you've borrowed. Lenders use it to really decide whether they want to loan you the money and at what interest rate. So the higher the score, the less risk you appear to be, and the better the terms that you can get. There are a few different credit scoring models out there, but the one that most mortgage lenders are using is called the FICO score. And your FICO score is calculated based on 5 main factors. The biggest factor, which makes up about 35% of your score, is your payment history. So this is simply whether you've paid your bills on time. Late payments, missed payments, collections, those all really hurt your score. And so consistent on-time payments will actually help it. The second biggest factor is about 30%, is your credit utilization. This is how much of your credit is available that you're using. So if you have a credit card and your $1,000 limit on it and you've charged $900, then your utilization is 90%, and that's hurting your scores. So keeping your utilization below 30% is generally recommended. And the third factor, about 15%, is the length of your credit history. How long have you had open accounts? Those that are open longer usually help your credit score. Newer accounts usually aren't a good idea. And the fourth factor is about 10%. It's a credit mix. So do you have different types of credit? A car loan, a credit card, a student loan? Having a variety of accounts can really help. And the fifth factor is another 10% is new credit. Every time you apply for new credit, it creates what's called a hard inquiry report on your report, which can temporarily lower your score. And opening several accounts in a short period can shoot a signal to them. Now, here's what I want you to understand. Your credit score is not a permanent judgment. It's just a snapshot. It just reflects where you are right now, not where you've always been and not where you're going. This is the question that I get all the time, and the answer might actually surprise you. It depends on the loan type, and we talked about loan types in my last video, so let me give you just a quick rundown here in the context of what it means in credit. So those conventional loans, the standard mortgage is not backed by the government, typically require a minimum credit score of 620. Some lenders may go a little bit lower, but 620 is about the general floor. FHA loans, they're backed by the Federal Housing Administration, and they are one of the most flexible options for buyers with imperfect credit. So if your credit score is 580 or above, you may qualify for an FHA loan with as little as 3.5% down. If your score is between 500 and 579, you may still qualify, but you'll need to put 10% down. But there's still a path to move forward when a lot of people assume that there isn't one. VA loans for veterans, active duty military, and surviving spouses, they don't have to have a set minimum credit score from the VA itself, though individual lenders typically look for around 580 to 620, and there's no down payment required. It's one of the most powerful loan programs available to those who actually qualify. Then there's the USDA loans for buyers in eligible rural and suburban areas of Arkansas, typically looking for a credit score about 640, though some lenders work with lower scores depending on the full financial picture. So let's be real for a second. If your credit score is 580, 600, or even 620, you are not disqualified. You have options, real options, and a good lender will help you find the right one. The number that disqualifies most buyers isn't their credit score. It's the assumption that their credit score disqualifies them before they've even had a conversation. Here's something important that a lot of people don't realize. Your credit score is just one piece of the puzzle. Lenders look at the whole financial picture. Income and employment stability, those matter a lot. Lenders want to see that you have a reliable source of income and that you've been employed consistently, typically for at least 2 years. This doesn't mean that you have to have the same job for 2 years, but it helps if you've been in the same field. So if you're self-employed, guess what? That's okay too. And you're likely will need 2 years of tax returns to document that income. Your debt to income ratio, or your DTI, is a big one. This is your percentage of your gross monthly income that goes towards paying debts. So lenders add up all of your monthly debt payments, so your car loans, student loans, credit card minimums, and the projected mortgage payment, and then divide that by your gross monthly income. Most loan programs want to see a DTI of 43% or lower, though there are some programs that allow a little bit higher. So like, for example, if you make $4,000 a month before taxes and your total monthly debts include your mortgage, which would be $1,600, then your DTI is 40%, and that's generally considered acceptable. Cash reserves, those matter too. Lenders want to know that you have enough money saved for your down payment and closing costs, and ideally a little left over after closing, so you're not starting completely depleted. Credit history versus credit score. There's a difference, okay? Your credit score is the number one, but lenders also look at the story behind it. A bankruptcy from 7 years ago looks very different from a pattern of recent late payments. That context matters. So the point is, even if your credit score isn't where you want it to be, the rest of your financial picture might be strong, enough to get you approved. The only way you know for sure is to talk to a lender. That conversation costs nothing, and the information you get from it is invaluable. Okay, before we get into how to improve your credit, let me talk to you about some of the most common mistakes that people make that hurt their credit, especially when they're thinking about buying a home. Y'all, missing payments. This one seems obvious, but it's the number one credit killer. Even one missed payment can drop your score significantly. Set up auto pay if you have it, put reminders in your phone, do whatever it takes to pay every bill on time, every time. Maxing out credit cards, using too much of your available credit, even if you pay it off every month, can hurt your score because of how your credit utilization is calculated. Try to keep each card below 30% of its limit. Closing old accounts. I know it can feel good to cut up an old credit card, but closing that account reduces your available credit, which can increase your utilization ratio and shorten your credit history. So in most cases, it's better to keep old accounts open, just don't use them irresponsibly. Applying for a new credit right before buying. Every time you apply for a new card, a car loan, or any kind of credit, it creates a heart inquiry that can temporarily lower your score. And if you're planning to buy a home in the next 6 to 12 months, hold off on opening any new accounts. Not checking your credit report for errors. This is one of the things that surprise people the most. Errors on credit reports are more common than you think, like accounts that aren't yours, payments incorrectly marked as late, or debts that you've already paid that are still showing as open. You're entitled to a free credit report from each of the free major bureaus, Equifax, TransUnion, all those, Experian, annualcreditreport.com, okay? Check those, make sure your errors aren't dragging down your score by 20, 30, or 50 points, the difference between qualifying and not qualifying. Okay, so let's say your credit score isn't where you need it to be. What can you actually do about it? The good news is that there are credit scores that can be improved, sometimes faster than people expect. Here's what actually moves the needle in the right direction. Pay everything on time. Start right now, today. Right now. I know I've said this, but it bears repeating. Payment history is 35% of your score. Even if you've had late payments in the past, building a consistent streak of on-time payments going forward will help you improve your score over time. Pay down those credit card balances. If you can get your credit balance to below 30% of your limits, or even better, below 10%, you may see a really meaningful jump in your credit score. This is one of the fastest ways to move the needle because utilization is calculated fresh every month. Become an authorized user on someone else's account. So if you have a family member or a close friend with good credit and a long-standing account, ask if they'd be willing to add you as an authorized user. Their positive history on that account can show up on your credit report and help you boost your credit score. You don't even have to use a card. Just being on the account can help. And then address those collections accounts. If you have accounts and collections, talk to a lender or a credit counselor about the best strategy. In some cases, paying off a collection can help your score. And in other cases, the way that it's handled actually matters. So don't just start paying things off randomly without understanding the impact. Get your advice first. And don't open any new accounts unnecessarily. Every new account lowers your average account age and it creates a hard inquiry. Only open new credit when it makes strategic sense. Give it time. Some things on your credit report just need time to age. Negative things like late payments, collections, and bankruptcies do fall off of your credit report eventually. Late payments fall off after 7 years, bankruptcies after 7 to 10 years, depending on the type that you filed. And just know that time is on your side for building good habits starting right now. And here's something really important. Talk to your lender early. A good loan officer can look at your credit report and tell you specifically what to do to get your score where it really needs to be. They've seen thousands of credit situations and they know exactly what moves will have the biggest impact in the shortest amount of time. This is not something you have to figure out on your own. Okay, I want to pause right here just for just a quick little second. If you're watching this and you're thinking, okay, I think I might actually be closer than I thought, I want to encourage you to take one small step today. Call or text me directly, 209-985-6476. You don't have to have everything figured out. You don't have to have a perfect credit score. You don't even have to know what questions to ask. Just reach out, tell me where you are, and I will help you find the path that is the best for you forward in whatever situation you may be in, okay? I work with all buyers across Central Arkansas, and I love helping people who thought home ownership wasn't possible for them, and then them realizing that it actually is. 209-985-6476. Save that number. I mean it. Okay, let's keep going, y'all. I want to spend a few minutes on this because it's something that really comes up a lot and there's a lot of fear and shame around it. So I want to just address it directly, okay? If you've been through a bankruptcy or a foreclosure, you are not permanently locked out of home ownership. There are waiting periods, yes, but there is a path back. Bankruptcy, Chapter 7. For a conventional loan, you'll typically need to wait 4 years from the discharge date. From an FHA loan, it's 2 years, and from a VA loan, also 2 years, and from an USDA loan, it's typically around 3 years. If you file Chapter 13 bankruptcy, this one has shorter waiting periods in many cases because you're repaying your debts through a structured plan rather than having them discharged outright. With FHA and VA loans, you may be able to qualify after just 1 year of on-time plan payments with court approval. Foreclosures, for a conventional loan, the standard waiting period is 7 years. For FHA, it's 3, VA 2, and then USDA is 3. There can be exceptions in cases of crazy circumstances like serious illness, a job loss, or death in the family that can sometimes shorten those waiting periods. I know these timelines can feel discouraging, but here's what I want you to hear. The clock is already ticking. If your foreclosure was 3 years ago and you're working toward an FHA loan, you might be closer than you think. If your bankruptcy was discharged 2 years ago, you might already be eligible. The only way to know where you stand is to have the conversation with a lender and with me. Don't assume, just find out. I have to talk about this because there's a lot of predatory information out there that is targeting people with credit challenges. You've probably seen the ads. We can remove negative items from your credit report. Guaranteed credit repair. New credit identity. These are almost always scams. And some of them are actually illegal, okay? Here's the truth. No one, and I mean no one, can legally remove accurate information, negative information from your credit report before it's supposed to fall off. Not a credit repair company, not a lawyer, not anyone. The only thing that can be legitimately removed are the errors, inaccurate information, and you can dispute those yourself for free. So if someone is promising to fix your credit for an upfront fee, be very skeptical. The Federal Trade Commission has resources that help you identify credit report scams, and I'd encourage you to check on those before you pay anyone to help you with your credit. What you can do on your own for free: check your credit reports at annualcreditreport.com and dispute any errors directly with the credit bureaus. Write a dispute letter, provide the documentation, and the bureau, they're required to investigate, okay? You can also work with a HUD-approved housing counselor for free who can help you understand your credit and create a plan to improvement. The Department of Housing and Urban Development has a directory of approved counselors on their website, and many of them specifically serve Arkansas residents. Legitimate help exists. You just don't have to pay hundreds of dollars for it. I want to be honest with you. Just a little something, okay? Not everyone watching this video is ready to buy a home right now, and that's okay. I would rather tell you the truth than to get you in a situation that isn't right for your financial life. If your credit is below 500, you're gonna need some time to build it up before most loan programs will work for you. If you have a significant debt that's creating a high debt to income ratio, that needs to be addressed first. If you're in the middle of a major financial disruption, a job loss, divorce, medical crisis, stability really needs to come before you even try to get a mortgage. None of that means home ownership isn't for you. It just means that the timing isn't right now. And here's what I tell buyers who aren't quite ready. Let's make a plan. Let's look at where you are, identifying exactly what needs to change, set realistic timeline, and work towards it. 6 months from now, a year from now, 2 years from now, you want to be standing at that closing table. The work you do right now gets you there. I've helped buyers get into, I don't think I can qualify, to I have the keys to my home, and I watched that journey completely change their lives. It doesn't happen overnight, but it does happen, and I'd love to be a part of that journey with you. Here's what I want you to take away from this video. I want you to know that your credit score does not define you. It doesn't tell the whole story of who you are, what you've been through, or what you're capable of. It's a number, and numbers, they can change. A lot of people who own homes today have had credit challenges, late payments, maxed out cards, a bankruptcy, a foreclosure, hard seasons of life that left marks on their credit report. And they found a way through. They did the work and they got the right guidance, and they made it happen. You can too. I promise you that. The first step isn't having a perfect credit score. The first step is just being honest about where you are and finding out what path forward actually looks like for you. That conversation, free, F-R-E-E, free, okay? It costs nothing except a little time and willingness to know the truth. If you're ready to have that conversation, I'm right here. Call or text me, 209-985-6476. You can visit me at ar-property.com, or you can shoot me an email at cat@ar-property.com. I work with buyers and sellers all across Central Arkansas, Little Rock, North Little Rock, Maumelle, Cabot, Bryant, Benton, Sherwood, Jacksonville, and beyond. And I speak Spanish and Portuguese. So if that's the language you're most comfortable in, please reach out. If this video has helped you, share it. If it has someone struck an image with you, send it to them. And stop telling yourself you can't buy a home because of your credit. It might actually be what you need to hear or what your friends need to hear. And if you haven't watched my first video, the full first-time homebuyer guide, go back, check that out. The link is in the description. It walks through the entire process from start to finish, and this is the perfect video to companion with it. Thanks so much for watching, and I'll see y'all next time.